So I want you to do it. I want you to now tell me the topics you have gone through. Under costing technique, you said you have gone through absorption costing, activity-based costing. What other costing techniques? Try to, make mention of it in your head. Not that probably flip back into any of your book and be telling me.
No,
Those you can tell me, fine. Those you can tell me, I'm okay, right? So next.
Yeah, I haven't gone. Okay. Activity-based costing, life cycle costing, environmental costing.
So let me talk about it.
Costing.
Life cycle costing. Life cycle costing. The third bit is environmental costing. The essence of making you mention is that one of the things that I realized that it helps students getting passed for this paper is when the students know the paper, when they know the paper, right? So is that all? Absorption costing, activity-based costing, target costing, right? Target costing. Is that all for now?
Yes, please.
All right. So that answers for the target costing. Then we move on to another umbrella of topics. We said it is called optimal production plan techniques. Optimal production plan techniques. And under optimal production plan techniques, what were some of the things that we talked about under optimal production plan techniques?
Key factor analysis.
So we said key factor analysis is not an area that all the time comes up on the day of exam. If the examiner asks you to do with key factor analysis, he will say that determine the optimal production plan, given the condition that profit is maximized. And this key factor analysis, that is where we are going to talk about calculating contribution per limiting factor, doing the ranking based on contribution per limiting factor, and now determining per the total constraint we have, determine how many units of A, B, and C to produce. And key factor analysis idea is applicable sometimes in the perspective of make or buy. But just that under make or buy, the limiting factor turns out to be material. And we tend to we have actually gone through one bit of make or buy question where material happens to be material in the form of raw materials becomes the limiting factor. And we said we have make or buy pertaining to where there's limitation, where there's no limitation. So key factor analysis as an optimal production plan tends to have a little bit of ideas in there. But what is testable for the make or buy side, as I explained to you, you need to know the fact what is important for exams is when there's material as a basis, right? As a limiting factor or bottleneck. In that case, you look at the price, the cost in, cost when you make it, cost when you buy it, you calculate your contribution also. The second bit under optimal production plan is also make or buy is not here. Make or buy is not an optimal production plan technique.
Yes. Throughput.
So we have
accounting,
throughput accounting. Then the third bit,
break-even analysis.
So we have what we call break-even analysis. Break-even analysis. Then what else?
The theory of constraint. That's
linear programming. The theory of
linear programming.
And I explained that all these, it is not only linear programming, which is called theory of constraints. All the techniques that we have looked at under optimal production plan are premised on the theory of constraints, because we now tend to think about the number of units to produce. That is the optimal production plan when there exists limitation, when there exists constraints, when there exists limiting factors or bottlenecks, right? So then we decided to look at some other bit of topics, right? So we decided to look at some issues pertaining to, we've dealt with some issues of short-term decision-making. So far, we've dealt with some bit of short-term decision-making techniques. Some of them, right? Short-term decision-making techniques. We've dealt with some of them so far. Then those ones that we've dealt with, over here, I'll pick it up myself. The first one was matter about relevant costing. So we've dealt with relevant costing. Then the second bit was matter of shutdown. Shutdown, right? I shared with you the video of shutdown.
Yeah, okay, I watched the video.
Yeah, so if you watch that side, that is okay with me. The only bit that I still want to remind you of that, if we are talking about shut down, if I decide to shut down a company, if I decide to shut down a particular department, now what are the issues pertaining to shutting down a particular department? In fact, the revenue that I would have incurred for still being operation, which that revenue was supposed to be a benefit, I'll lose it. So that revenue now is going to be in brackets. Now, the cost, the variable cost of producing items, right? Which would have been a cost that I've incurred in producing the item. This time, because I've shut down that department, I will not incur that cost anymore. So that variable cost become a cost saved. Again, any specific fixed cost which relates to, shutting down that department, not the general first cost, but the specific cost which comes with that department also going to be saved. So we look at shutdown, whether to shut down or not to shut down, based on cost and benefit analysis. And that recorded section that I shared with you should be enough to make you understand the theory of what shutdown. But what is important over there also happens to be make or buy decisions. Make or buy decisions. Make or buy decisions. Right. I hope you are with me.
Yes, please.
Right. Now, there's one bit of the short-term decision making which we have not looked at, and that is further processing, which I'll clear that, right? I'll clear that using question, further processing. So let me put us times behind it. That one has not been cleared. But today, what I'll look at with you is going to be pricing. Is going to be pricing. Then after looking at pricing today, pricing, we cannot give it under any umbrella. So we look at pricing. Then after pricing, we look at risks and uncertainty. We look at risks and uncertainty. Then after risks and uncertainty, I now pick up the question under further processing. We'll do it. Now, if I'm able to clear further processing, pricing, risks and uncertainty, then I know for sure that I am almost through with about, let me just say, 62% of the syllables. Then I know for sure I'm almost through with about 62% of the syllables. So we don't have much, time left behind, because you are taking the exams in December and you should register by now, right? So when you talk about costing techniques, you've gone through matters pertaining to optimal production plan, you need to go through. You are supposed to pass this paper straight up. So do a lot of work. Do not think that the exams is far away. That is one of the mistakes that a lot of students tend to do. They tend to think that it's far away. But what this paper needs, it needs a lot of work. Repeatedly going in back and forth, try to recollect what you've learned. Even if you are somewhere, you cannot, what did I learn today? You know, they are the sort of issues that this paper needs. You need to know the paper like your skin, right? So let me move in quickly without delay. Now, before I will look at matters pertaining to pricing today, I opted to come out with a refresher of an idea, right? Pertaining to some topics that we have looked at. This is a beautiful question by all standards, testing application on these topics. Now, let me read the question. We go through that before looking at pricing. I want my interaction with you to also be questions, textbook, but most importantly, because the videos will be shared, the question is fine. I don't want my meeting with you to be only a textbook of pricing. Even the pricing, deal with you pertain to some important bit, right? So the requirement says that calculate the profit for the period using A, absorption costing, B, marginal costing, C, throughput accounting. Calculate the profit for the period using this. I'm back. Sorry, I got disconnected, but I'm back. I decided to reposition myself when I got disconnected. So I think it's going to be better than before.
Yes.
Right. So I'm talking about issues of calculating the profit for the period using absorption costing, marginal costing, throughput accounting. This question turns out to, tease our minds with the assumptions the concepts behind absorption costing, marginal costing, throughput accounting. The net effect is we are calculating profit. And you know for sure that profit can be calculated as, watch this, profit can be calculated as sales minus variable cost minus fixed cost. That is one way of calculating profit. And this style, we are going to use what we call absorption costing. Let me make absorption costing AC. Then we can also calculate profits pertaining to marginal costing as sales minus variable cost. We said marginal costing. So sales minus variable cost. And that sales minus variable cost is what is going to give us contribution. So it is going to be contribution minus fixed cost, so that we get what? Profit. And here we call that what? Marginal costing. Don't forget that we said that it is only marginal costing we talk about contribution, right? But under absorption costing, don't talk about contribution. What is important under absorption costing AC is straight away profit, right? But under marginal costing, you need to show a line as contribution, right? So then we come to, so at least we know how to calculate profit under absorption costing as sales minus variable cost minus fixed cost. We know how to calculate profit under marginal costing as contribution minus fixed cost. Then we can also calculate profits under throughput accounting as sales minus material costs, then minus all other costs. In fact, even the variable cost all becomes first cost over here. So I'll put it in bracket, first cost. So this is what you call throughput. Throughput. That is the way of calculating throughput. Have you recorded the assumptions of absorption costing, marginal costing, and throughput accounting?
Yes.
Right. So if you have, then the only bit to talk about is a matter of calculating profit for unsold inventory. And it's coming by an assumption per this question, right? Had it not been that, there wouldn't have been the calculation of that. But here, there exists an assumption like that. Now, the requirement still stands the same. Calculate the profit for the period using absorption costing, marginal costing, throughput accounting. Now, we are saying that assume for the purpose of absorption costing that budgeted and actual production overheads were the same, and there are no other or over-absorbed overhead. What are we trying to tell you? We are trying to remind you that absorption costing and marginal costing are overhead valuation techniques, right? Good. Now, let's read the entire question. A company makes 1,000 units of a product during May. So they produce 1,000 and sells 800 units for 32,000. So this 32,000 happens to be the total sales. They produced 1,000, but they ended up selling 800 for 32,000. If we should ask you to calculate the selling price per unit, you should be able to calculate the selling price per unit. In that case, how would you have calculated the selling price per unit? Can you help me, or mute your speaker and help me? Selling price per unit,
Yes,
how would you
please.
have calculated that? So it's going to be...
It should be the 32,000 divided by the 800 units.
By the 800 units. Excellent. Right. Now, do not use the 1,000 because the 1,000 is what you produce, but you couldn't sell that, right? So times up for that answer, which will give you something like 40, isn't it? So to give you 40, right? 40 Ghana cedis.
Yes.
Right. This is part of just an analysis. It's not a part of the answer of the question. So they produced 1,000, they sold 800 for 32,000. There was no inventory. This is the dangerous side of this question. There was no inventory at the beginning of the month. So what do you mean? At the beginning of May, there was no inventory. That means that the closing inventory of the previous month, which was April, which was supposed to be the opening balance in May, was 0. But in this regard, at the end of May, they produced 1,000 and they only sold 800. Doesn't it mean that we have 200 left in inventory? That is it.
Yes.
That we are left with 200 in inventory. And the assumption is that no inventory should be left at the end of the year. That means that even the 200 which is left, you need to assume that it is also going to be sold. So that is the only side, because we explained that throughput accounting is mostly cemented on the theory of just-in-time environment where there's little or no inventory. And we assume that in the just-in-time environment, the JIT environment, total demand from customers should be equal to total supply from the producer point of view. So I'm going to solve the question by presenting profits in the perspective of absorption costing, then present it on the basis of what? Marginal costing. So profits under absorption costing. Under absorption costing. Profits under absorption costing. Right. Now, the theories of absorption costing, marginal costing, and throughput accounting have no bearing on sales. They have no bearing on sales. They cannot change sales. Why do we say that? Because absorption costing and marginal costing are overhead valuation techniques. They only come in when we are producing the product and we incur what? Overhead cost. They do not have any impact on what? Sale. They only come in when we are making or producing the product, but they have no impact when we are selling the product. So in this regard, the sales value will be unchanged. The sales value will be unchanged. It is still going to be what? 32,000. Now, we come to, because we are talking about absorption costing, the absorption costing will put all the costs together. So we come to the variable cost side. Now, what are the variable costs in this question? The first variable cost happens to be the material cost, which is 6,000. Do you agree with me?
Yes, please.
The next one happens to be 8,000. So in effect, we have a total variable cost of 14K, 14,000, 14K, right? Then we have fixed cost. Fixed cost is the fixed production overhead. It is also attributable to production. So we have that to be 10K. Now, surprisingly, there's another overhead, but that overhead is not attributable to production. It could be an overhead coming by selling and distribution, right? And it's not by production. So we tend to say other overhead, O/H, other overhead, right? And that is not production, it is non-production. So you separate that, don't combine them, separate that, but they are two different things. So at the end of the day, by subtracting all costs, from the sales value, what will be the gross profits? What will be the gross profits?
3,000.
So that is 3K. But surprisingly, because of the assumption of no inventory at the end and also at the beginning, so there was also an element of profit which was left in the unsold inventory. So we need to also estimate that, right? So this is one of the questions, if you have not seen before, when it comes up on the day of exam, you don't know how to deal with it. Profits from the unsold inventory. We assume that though those inventory is not sold, but because of the caveat of no inventory, that portion of 200 units left will still be sold. We will make that assumption.
Sorry, did you say provision?
Yes. Oh, sorry. Profits. Supposed to be profits. Profits. The reason why I made a mistake by writing provision is that we have the same principle in financial reporting in consolidation, where an inventory is not sold. We call it provision for realized profit. That was it. Provision for realized profit, the shortcut as PAP, PUP, right? So, right, that's a good thing. So in this regard, we have 200 out of the 1,000, which is actually what? Not sold, but there's going to be a unrealized profit coming from that. Now the question is, calculation of the unrealized profit is based on what? So in the first instance, it is 200 over 1,000. But 200 over 1,000 times what? That is where the problem comes in, right? So 200 over 1,000 times what? Now, understand that in management accounting, in performance management, management accounting, and performance management, the same bit, right? We tend to all the time estimate provision for unsold inventory or profit for unsold inventory. If it is absorption costing, you estimate that on the total cost attributable to production. Listen, if it is absorption costing, we calculate the profit on unsold inventory on the basis of the total cost attributable to production. And here, what is the total cost attributable to production? We have the variable cost attributable to production. It is directly, all variable cost is directed to production. Then the fixed production overhead, which is also production, right? So it is going to be 200 over 1,000 times 24K. That is 24,000. And what answer are we getting?
What? 4,800.
So 4,800. So at the end of the day, we will find the total net profit. So we call that net profit, right? So the total net profit will be the total of here, which is 7,800, right? Good. So that ends that part. If it is what? Absorption costing. Can I move on to the next one?
Yes, please.
Right. So profits and the marginal costing. Profit and the marginal costing. Now, if we are using marginal costing, as already explained, the sales value is not affected. So there's still 32,000 because it has no bearing. Marginal cost has no bearing with what? Sales. Then under marginal costing, there's supposed to be a line as what? Contribution. So over here, we will less what? Variable cost. And what is the variable cost, if you can help me? What is the variable? 14K. 14K. So you subtract that 14K from 32,000, then we will get something called contribution.
Contribution.
Get something called contribution. And he said the value is what? 18, isn't it? 18K. Now that you have this 18K, we will now, since you have created a line for contribution, then we can now bring in our fixed cost. So the fixed cost happens to be what? 10K, isn't it?
Yes, please.
Right. And there was other non-production cost. So other non-production cost. And that non-production cost was 5K. So 5K. So at the end of the day, when you subtract the fixed cost and the other production cost from the contribution, what are we going to get? To get the gross profit, of what? 3K. So you can see that the gross profit does not change, irrespective of whether it is absorption cost or marginal costing. But the next bit is to calculate the profit, right, from unsold inventory. Profit from unsold inventory. And the profit of unsold inventory, we said that we look at what is attributable to the production. But in the case of our absorption costing, because absorption costing tries to absorb both the fixed and variable overhead, if you remember, both the fixed and the variable element, that is what absorption costing does. But when it comes to marginal costing, it only absorbs the variable side and treat the fixed cost as a period cost. So what is attributable to production is only the variable side when it comes to marginal costing. The fixed side is treated as a period cost. Do you remember that principle?
Yes, yes. Please.
So then we are going to calculate the provision for realized profit as 200 divided by 1,000 times only the variable cost, which is going to be 14K. So what value are we getting?
2,800.
2,800. So at the end of the day, we find the total, then we will now get the net profit. So let me put over here. So start with the last bit. Net profits. Net profit. And that net profit is going to be what? 5,800. 5,800. That is it. We are left with the last issue, which happens to be, let me use it over here, profits and throughput accounting. Throughput accounting. Now, throughput, we know of matters of what? Sales not being affected. So the sales is still 32,000. Then under throughput accounting, we said that we only less what? Material cost.
Material cost.
Material cost. Material cost. So the material cost in this regard happens to be what value?
6,000.
6,000, so 6K. Then after you subtract 6K from 32,000, we will get what you call throughput. So you have the throughput. And the throughput will give us what? 26K. After having the throughput, we are now going to subtract the other cost, which will all become fixed cost. Do you remember?
Yes, please.
And the throughput accounting is only material cost, which is variable. All other costs, even the variable ones, will become fixed cost. So all cost, that becomes what? A fixed cost. Over here, add them up for me. So it becomes, apart from the 6,000, it becomes 8,000 plus 10,000 plus 5,000. Do you agree?
23,000. Yes, please.
So it becomes what?
23,000.
23K. Then you subtract that 23K from 26K. Then you get the gross profit. Gross profit. So the gross profit happens to be what? 3K.
3,000.
Then we are now going to assume the profits from the unsold inventory. Now, it is still going to be the same apportionment of 200 over 1,000. But now the problem over here is that we still consider the cost which is attributable to what? Attributable to production and the accounting. And here it is going to be the material cost. And that is going to be 6K. So what is the value? 200 over 1,000 times 6K.
120.
Is it 120?
Sorry. 1,200.
1,200. So now that we have our 1,200, what you say is that then the net profit in that regard is going to be, the net profit in that regard is going to be 4,200. 4,200. Right. So that is the solution in the case of the question that we are having above. Right. So just a refresher of the assumptions of those techniques. If you are fine, then I'm now going to proceed to look at pricing. If you are fine, then I'm not going to look at matters about pricing.
Yes,
right. There are still recorded sessions available for you, so I'm not sure it's going to be too much of a problem. This document, I'm going to save it, right? I mean, the documents I worked with, I'm going to save it. So let me just say refresher on absorption costing, marginal costing, and throughput. Let me put it in that context so that at least I share the document. Right, so let me share with you now on WhatsApp. So let me share with you now on WhatsApp so that at least, so I think I can go to downloads, so refresher on that. Okay. So I've shared with you. Oh, I picked another one. I'm coming.
Okay.
Okay, I think we are fine. Happens that way there. Okay. So I share with you. You're good. Pressure on that. Okay. So we are fine now. We come to pricing. I don't know if I've received it.
Yes, please, I have.
Okay, so I'll now come to pricing. Then, so let me share my screen. Then we'll look at how to deal with pricing bit. Share my screen. Stop share. Share now. Matters of pricing. Right. So this is a technical article, but because I'm going to share with you recorded sections for you to go through for me, right? Using the time available, I'm going to share with you recorded sessions for you to go through for me. What I want to do is to give you the summary of the most important things. I do not want to go through some things on pricing with you when the recorded sessions I'll share with you have the same thing. No, I want us to make good use of the time. So what I want to navigate you through, the first bit, let me just come here. So pertain to pricing, we are going to come up with the steps. Now, what are the types of pricing questions that comes up? Now, first of all, when you talk about pricing, after you have determined the cost of the product, you have determined the number of units to produce. You now need to determine the price of the product. And you determine the price of the product by knowing the cost of the product. Then you add some element of what? Profit, either a margin or a markup perspective. Then you will now get your selling price. You can sell to the outside world. So it is important that the performance manager also determine the price of a product. And before determining the price of a product, you look at how much cost you have incurred and other factors of demand out there. Right. Now, the day of exam, per our experience, there are two types of pricing questions. The first type of pricing question happens to be the basic form of microeconomics type, where there's going to be a table like this. Watch what I'm displaying now. So there's going to be a table like this, where they're going to give you the first side, they're going to say quantity, QTY. Then the next one, they're going to give you, let's say, total cost, something like this, total cost. Then they'll put in a figure. Here says 0. Watch out. They say 0, 200. Then they will say, let's say 1. They say 1. Let's say 450. Then they say 2. I'm just making an example, right? So they say 850. Then they say, let's say 3, right? 3, let's say 1,050. Then they'll ask you to calculate, watch out, they'll ask you to determine the first cost, the total first cost. Then they'll ask you to determine the total variable cost. Are you with me?
Yes, please.
Right. So if you want to go through such a type of pricing question, you need to remember that in economics, right? When production is 0, that means there's no fixed cost, there is no variable cost. Anytime the production of a product is 0, that means you have not produced any product. You will not incur any variable cost. So at that point in time, the fixed cost is equal to the total cost. So over here is 200. And the variable cost, total variable cost is 0. Do you agree with that concept?
Yes, please.
Right. Then, since fixed cost does not change in every regard, then we can say that this side is 200. Here is also 200. This side is also 200. Then we believe that total cost is equal to total fixed cost plus total variable cost.
Total variable cost.
So if in the first output That is output one. Output one. If the total cost was 450, then the total fixed cost was 200. What would be the total variable cost? It's just a matter of subtracting the total fixed cost from the total cost. There you go. This is the same principle that the principle of high or low method also tend to use. High or low method, if you remember. I hope you remember.
Yes.
Right.
Yes.
So over here, what would be the total variable cost?
250.
So that is 250. Right? Then what about this side?
650.
650. You're good. And the last side?
850.
850. So that big. So they can ask you to calculate average variable cost, which is not supposed to be, but sometimes they can ask you. So you need to prepare yourself for that angle of questions, right? So they make it as if it is economics. They make it as if it is economics. So average variable cost is the total variable cost divided by what? Quantity. So they are taking you back to your economics, your root. Then they can ask you to calculate the average fixed cost. Average fixed cost is going to be the total fixed cost also divided by what? Quantity. Are you with me?
Yes.
Right. I want to ensure that you are with me and are getting an understanding. So we can say that then the average cost is equal to average variable cost plus average fixed cost. We can also put that assumption in. Are you fine?
Yes, please.
Then total revenue is equal to what? Price times quantity. Price times quantity. That is how to calculate total revenue. And if you have total revenue, we can ask you to calculate what you call average revenue. Average revenue is total revenue divided by also quantity. Divided by also quantity. Then the last bit is that marginal revenue is equal to the change. Watch that. Is the change in total revenue. Change in total revenue. Change in total revenue divided by the change in quantity. Are you getting it?
Yes.
Right. But what also matters here, which is a broad idea, even in dealing with pricing bit of questions, type 2 bit of pricing question, which we will look at, is when we believe that at the point of optimality, marginal cost should be equal to marginal revenue. And this is what we pick up even in the case of pricing question type 2 to look at. So that is why we tend to look at what? The point of optimality, right? So optimality. If you want to make profits or equilibrium, let me put it in that context, right? Optimality. Right? Good. So this turns out to be one phase of pricing questions that tends to feature for us to look at. The session is recorded, so I'll share with you the recorded section later. Now the type 2.
Okay.
So this is type 1 bit of pricing question. Then type 2 bit of pricing question is the normal type of questions of pricing, where we need to recall the sort of issue. So we tend to see us giving you a formula. You first of all calculate, if you have seen this formula before, MR equals A minus 2BQ, right? 2BQ.
Yes.
Then we said price is equal to A minus BQ, right? This sort of, then we tend to come up with the next formula. B is equal to change in price over change in quantity. Over change in quantity. Change in quantity. Then we tend to also say that At the point of optimality, MR should be equal to MC. Then we also indicate that if the variable cost is given to you, the variable cost is equal to the marginal cost. Note that that is the assumption. So if the examiner gives you the variable cost, that variable cost can be used for what? To replace the marginal cost. Because we believe that marginal cost, MC, marginal cost is the additional cost incurred for having produced the additional product. That is to say that variable cost is also sensitive to production. And in performance management, we say variable cost is equal to marginal cost under pricing. But in overall economics, university economics, variable cost is different from marginal cost. And that is what you need to put in mind. So when you want to calculate marginal cost, also in economics under type 1, you say marginal cost is equal to change, right? Change in total cost divided by change in quantity. Are you okay?
Yes.
But when you come to type 2, when the examiner gives you the total variable cost, such as total material cost, labor cost, and variable overhead, when you add these three, it should be equal to the variable cost and it should be equal to the marginal cost. That is what you need to note. So what I'm going to do is that I'm going to assist you in the case of the type 2 form of pricing question, which normally comes up. Step 1, step 2, step 3. So steps in calculating the price of a product. So step 1, here you have to be with me. Step 1, what we do basically, step 1 is that we need to calculate the B, right? Which the B is what? The change in price over change in quantity. Over change in quantity. Then after getting the B, what you do is that, second, you calculate the A, right? What is the A? So you calculate the A at the point where we say, so calculate the A given a known price and a known price. Let's say, give me a known price into bracket P, comma, the B, which you've already calculated, and a given quantity. So in which formula? Using P equals A minus BQ. Right. So if you have the P, if you have the B, if you have the Q, you should be able to calculate the A. Are we fine?
Yes, please.
Then come to step 3. Step 3. Use, so rewrite, let me put it in that case. Rewrite the price equation as the P equals, this time around, the A that you got. So for example, 450, right? Minus the B. Let's say the B was 0.1. Q. You write it like that, right? So let's just say, example here, you got it to be 0.1, right? And let's say, example here, you got the A. So example, A is equal to 450. I'm just giving figures, isn't it?
Yes.
Right. So you will write it in that form. And what you have to do is that step 4, let me make it step 4, generate the marginal revenue equation from the price equation in step 3. And what is the marginal revenue equation? The marginal revenue equation is MR equals A minus 2BQ. So it is just a matter of multiplying the B by 2. So here it is 450 minus, then what is 0.1 times 2? 0.1 times 2 is 0.2 Q. Do you agree?
Yes, please.
Right. So that ends it in the case of how you can get the marginal revenue. Then it is left with marginal cost. So all that we have done over here, right, from step 1, step 2, step 3, step 4, is all about calculating marginal revenue. Put this somewhere for me. All these bits are all about calculating marginal revenue. Are you with me?
Yes, please.
Right. So all that here is about calculating marginal revenue. Step 1, step 2, step 3, all these things are to calculate marginal revenue. Because we want to get to the point where marginal revenue costs marginal cost. That's where we want to get to. Now let me move on. So we are done with marginal revenue, isn't it?
Yes.
Now the next thing is to now calculate marginal cost. And that's where the problem is. Now, we have explained that in calculating marginal cost, when the examiner gives you variable cost, you use it to, to say that the variable cost equals that. So I'll just say method one, right? Method 1. The marginal cost is equal to the variable cost. And that is going to be direct material cost, direct labor cost, and variable overhead. Are you okay?
Yes, please.
Over here, let's imagine that the examiner gives you the direct material cost to be 1,000. The direct labor to be 400. And the variable overhead to be 230. You just add them up. Then here you get 1630. So that becomes the total variable cost. And you just go and equate that 1630 to the 450 minus 0.2 Q. So it becomes 450 minus 0.2 Q equals 630. Then you solve for Q, isn't it? Hello?
Hello, sir.
Then you solve for Q, isn't it?
Yes, please.
So when you get Q, they now put the value of Q into the price equation. Right. So that is the first step. When the examiner gives you the variable cost straight away, that variable cost you have given to you straight away is equal to the marginal cost. And that marginal cost, you equate it to the MR equation. Are you fine with that side?
Yes.
Because I'm going to talk about method 2, and that is the complicated side too. So can I move on to method 2?
Yes, please.
So method 2 is when the principle of high or low method is applied. When the principle of high or low method is applied. Now, in the principle of high or low method, if you remember, we said we can use high or low method to calculate, to separate variable cost and fixed cost from total cost. Do you remember?
Yes, please.
And the first thing we calculate in high or low method is the variable cost per unit. You remember?
Yes.
So in that case, the variable cost per unit becomes the highest cost, right? The highest cost minus the lowest cost right? All divided by the highest cost will have its corresponding what? Quantity. So that is the units of the highest minus units of the lowest. Are you fine?
Yes, yes.
And when you get that variable cost per unit, we said that that variable cost per unit is equal to the marginal cost per unit.
Yes, please.
If you want to find the total marginal cost in total, you multiply the marginal cost per unit by the total quantity, then you get the total. Are you fine?
Please, can you take it again?
I'm saying that when you get the variable cost per unit, it's equal to the marginal cost per unit under pricing. Are you fine with that?
Yes, please.
And I'm saying that when you need the total marginal cost, right? Because at the end of the day, we look at MR equals MC. So if we're saying the variable cost per unit equals the marginal cost per unit, and if you need the total marginal cost, then it's going to be the marginal cost per unit times the total quantity produced.
Yes, please.
Okay. Then we come to the third method. The third method is when we are applying. So when the principle of learning curve theory is needed in calculating the labor cost. So I'll just say part of variable cost. So the examiner wants you to calculate the variable cost. And at the end of the day, the variable cost becomes the marginal cost, which we are going to equate to MR. But in your quest to getting the variable cost, which we know variable cost comprises of direct material cost, direct labor cost, and variable overhead. The portion of the, let me just conclude, and let's say high or low method. Let me make it complicated. So over here, we are looking at method 3, M3, where we are calculating the variable cost. And the variable cost, you know for sure, we have material cost, isn't it?
Yes, please.
That one will not be a problem. But the labor cost, he will intentionally bring in the principle of learning curve theory. And we need to use that learning curve theory application that we have in calculating the labor cost. Then, when you come to the variable overhead, he will give you the total overhead, expecting you to use the principle of high or low method to fish out the variable overhead. Are you okay?
Yes, please.
Are you seeing how interesting this may be in the examiners can actually be certain that we creating stories to beat you if you are not really prepared?
Yes.
Right. So that is so far the issues that are at hand that you need to master. So you should know the link between or among topics under the performance management. Here we are talking about pricing, but you hear that there are matters of what? High or low method coming in, matters of learning curve theory coming in. You get it? That sort of relationship with topics that we need to understand. I'm making it clear again that it is only under pricing performance management where we assume that variable cost is equal to marginal cost. Take that for me.
Yes.
That is when we are dealing with pricing method 2 type. Are you okay?
Yes, please.
Right. Now, any other bits, so master this. These are the sort of things coming up on the day of exams. Know the styles. Not every question will bring out the styles. So know which of them, master them and be alert. If you bring it, I'll do A, B, C, D. Okay. So I've already come up with the recorded sections pertaining to these things already. And that's why I'm not going to, walk you through them, right? I'll share with you also this technical article. You can navigate yourself through it and keep yourself okay, right? Good. But the most important bit is what I've already walked you through. And what I'll do basically is to share with you a past paper, which you need to go through and give me your response. Whether you look at the solution or not, I mean, I want you to go through and tell me that you are fine. If you are not fine, whoever is creating the issue, I need to explain that to you. So I think that I have brought you to the exam perspective in terms of pricing, what is needed, letting you know the types of pricing questions, type 1 and type 2. The type 2 is where the complications set in. And I've given you the steps. The session is recorded, so I'll share with you the video thereafter for to keep yourself in good shape. Right. So I'll end here. I'll share with you this PDF. Let me share with you via email. Should I share via email? Let me share via email. So I don't want to save it. So that's why I want to share this via email with you. So just give me a moment. It will come via email, then we are good to go. Just a moment. Outlook. It will come very soon.
Okay.
I want to ensure that I've shared with you because I don't want to forget it. It doesn't matter. I can even save it. I think let me go by that style. I'll save it. Then move on. Okay, they are telling me I'm already sharing it. Okay, it's not a problem. Let me far. Okay, so that is it over here. So I've sent that. Let me check if it has been sent. Okay, so it's sending. Not sent, but sending. Okay, I think it has been sent now. Check, you should have it by now. So what I'm going to do is to now share with you the recorded section, right? So I'll end here. I'll end the section now.